The white coat investor recently wrote an article in which he listed 5 reasons not to buy index universal life insurance. In today's video, I'll debunk those reasons one by one. Hey folks, David McKnight here, best-selling author of The Power of Zero. The white coat investor is an emergency room doctor turned financial guru who dispenses financial advice about, well, just about everything these days. And yes, he and I have a fairly extensive history of sparring over the years. The first time was back in 2018 when he claimed that tax rates would not be going up in the future due to unfunded obligations like Social Security, Medicare, and Medicaid. The federal government will instead try to print their way out of their problems. I responded that since Social Security, Medicare, and Medicaid are all tied to inflation, and since printing money causes inflation, then this wasn't a viable way to solve the problem. By printing more money, the cost of these programs would go up commensurately. It's like a dog chasing its tail. You couldn't print enough money to solve the problem. We later sparred over the viability of the Roth conversion. He said Roth conversions weren't a good move because, once again, tax rates are not likely to go higher in the future. Well, all that changed in 2019 when he saw Joe Biden's tax proposal. He then posted this tweet. These proposals read like a war on investors. Let's see, losing long-term capital gains brackets, small business taxes raised, no more step-up basis, real estate investors hit, and energy investors hit, tax what you want to see less of. If this were passed, I think I'd do a huge Roth conversion. So this is a bit of an about face for the white coat investor. He went from a position where very few, if any, Americans should consider the Roth conversion to, if Joe Biden gets his way and the highest marginal tax bracket reverts to 39.6, he of all people will preemptively execute a massive Roth conversion before those tax increases go into place. I told him I'm glad you're coming around, at which point he blocked me. So that brings us to today, where he insists that index universal life insurance isn't a good investment. Let's take these claims one at a time. Number 1, you don't need a permanent death benefit. Here's how the white coat investor begins. Quote, the vast majority of Americans, and especially high-income Americans like physicians, will at some point no longer depend on their earnings from work in order to live. This is called financial independence. Once you reach this point, you generally no longer have a need for life insurance, close quote. Well, while one could quibble over the need for a death benefit in retirement, there is one very good reason why you would almost certainly need a death benefit, and that's to pay for long-term care. There's a 75% chance that either you or your spouse will need long-term care prior to life expectancy, and the consequences of having to pay for long-term care out of pocket can be catastrophic. We're talking about burning through a lifetime of savings in just 3 or 4 years. Most IUL carriers stipulate that you can receive your death benefit in advance of your death for the purpose of paying for long-term care. And should you die peacefully in your sleep, never having needed long-term care, someone's still getting a death benefit, probably your kids or your grandkids. Contrast this with traditional long-term care insurance, which is a use it or lose it proposition. You could pay premiums for 30 years, die peaceful in your sleep, never having needed it, and they don't send you your money back at the end. It goes to pay for someone else's benefit, and that can be a source of heartburn for a lot of different people. When my clients who are over age 55 evaluate all of the different ways to mitigate long-term care, they choose IUL nearly every single time. It's long-term care protection without the heartburn. Number 2, complexity does not favor the buyer. Here's what he says, quote, IULs have many moving parts. The more complex the policy, the less likely you are to really understand how it will work in the future. The less you understand, the more likely you are to be disappointed when you eventually compare the steak to the sizzle you were sold. Also, the more complex the product, the fewer competitors it will have, and competition drives prices down, close quote. Imagine extending the same explanation to all the other things in your life that you don't fully understand. I remember I had a friend who just bought a new Lexus. I asked him why he preferred Lexuses over some of the other luxury cars. I expected a discussion on the engine's torque or the miles per gallon or the amenities that were included or the statistics on its reliability. His response surprised me. He simply said, when I put gas in it, it goes. Now here's a guy who didn't understand how the car worked, but was happy to shell out a substantial amount of money to buy one. I'm not sure that I buy the argument that we should only buy things that we fully understand. I don't understand how my computer functions. All I know is that when I turn it on, it works. All that said, the story behind the IUL is, in broad strokes, relatively simple. Exposure to the upside of the market with a guarantee that you'll never lose money in the market. Yes, there are some moving parts, and yes, some of those levers can be constrained by economic circumstances, but this much I know, the IUL has worked over a sustained period of time. And as I've said in past videos, two extremely reliable carriers, which I routinely recommend to my clients, have shown between 7% and 8% returns since 2006. Do you need to understand every minute detail to be able to benefit from those safe and productive rates of growth? Well, I'll let you make the call. Number 3, IULs don't count dividends. Here's what he says. Quote, you have probably heard that the stock market returns 10% in the long run. While this figure is approximately true, at least on a nominal, non-inflation adjusted basis, it includes the stock dividends, not just the change in the index value. IULs, however, only pay you based on the change in the index. So what's the big deal, you ask? The big deal is that if you go back to 1870, the average dividend yield of the stock market is over 4%. Even now, at historically low yields of around 2%, the dividend still accounts for 1/5 of the market return. So if an index mutual fund goes up 10%, including a 2% dividend, an IUL may only credit you 8%. Lack of dividends has long been positioned as a negative by critics over time. Sure, IULs don't include the dividend, but that dividend is typically taken off the portion of the growth that's above and beyond the cap. So for example, let's say you have a 12% cap and the S&P does 18% in a given year, including the dividend. Well, if you remove the dividend, you may only be left with 14%, in which case you'd be credited the full 12%. No harm, no foul. Furthermore, we can once again look back at our historical rates of return and say, if we can consistently average between 6 and 8% gross of fees over time, do we really care if dividends aren't included? Moreover, we have to remember that the IUL is not a stock market replacement. It's a bond alternative. So we should instead be asking ourselves how we would feel if we consistently averaged 6 to 8% gross of fees over time in the bond portion of our investment portfolio. When you factor in an average expense of 1% over the life of the program, we're talking 5 to 7% net of fees over time. And all that without taking any more market risk than what you're accustomed to taking in your savings account. Number 4, IULs have cap rates. Here's the white coat investor. Quote, to make matters worse, IULs usually have a cap rate. That means if the stock market has a really great year, such as the 30% index return in 2013, your return is capped at some lower figure, often in the 10 to 15% range. How much does that matter? Well, imagine if your policy had a cap of 12%. Anytime the S&P 500 index returned more than 12%, you just get 12%. How often does that happen? Since 1928, the S&P 500 has had an index return of over 12% 44 times, or about 52% of the time. It happens more often than not, close quote. Not really sure why he brings this up. When you enter into the IUL contract, you understand that in exchange for the guarantee against market loss, you'll be limited on your upside. That's the primary reason you choose the IUL over, say, a VUL, upside of the market up to a cap with a guarantee against market loss. IUL is a bond alternative that has a greater return, lower risk, and a lower standard deviation than a traditional bond portfolio. You wouldn't get any of that without the floor and the cap. Once again, a financial guru makes the mistake of comparing the IUL against the stock market over time. It's not how I position the IUL, nor how most responsible financial advisors position it either. Number 5, IULs have participation rates. Here's what he says, quote, if that wasn't bad enough, there is also something called a participation rate. If your participation rate is 80%, that means that if the stock market goes up 10%, not counting dividends, you get 8% credited to your cash value account. After 30 years, a nest egg growing at 8% instead of 10% ends up 42% smaller, close quote. Okay, this is where the white coat investor really cartwheels off the tracks. This is where he reveals how shallow his understanding of the IUL really is. He's saying that not only do IULs have caps, but they have participation rates as well. In fact, he seems to be saying that you could have both a cap and a participation rate within the very same index. Folks, this is not how the indexes in these programs work. You either have a cap or you have a participation rate with no cap, but you almost never have them within the very same index. So if the white coat investor gets this most basic of IUL details wrong, you have to wonder what else he's getting wrong. Folks, once you sift through all of the opinions and half-truths of the online financial gurus, what you're left with are a couple of basic facts. And the facts are this: IUL has performed consistently over the last 15 years, notwithstanding broad fluctuations in the economic factors that most impact IULs. We're not promising the moon here. We're not saying the IUL is a stock market alternative. We're simply saying that if you can get 5 to 7% net of fees over time, and you can get a death benefit that doubles as long-term care along the way, then it's probably worth looking into. If you want to learn more about how to incorporate IUL into a balanced, comprehensive approach to tax-free retirement, be sure to check out my tax-free toolkit. You can download it for free at taxfreetoolkit.com. By the way, if you have any comments or questions, feel free to drop them into the comment section below. I respond to every single one of them personally. And don't forget to click like, subscribe, and the bell so you never miss a video. This is David McKnight. I look forward to seeing you on the next video.